In early 2026, central banks crossed a quiet threshold. For the first time in 30 years, their gold reserves surpassed their holdings of U.S. Treasuries. Markets called it diversification. Economists called it hedging. They misdiagnosed the symptom as the disease. Here's why, starting with the numbers. In Q1 2026, gold rose 12%. You're seeing them now, gold up 12%. 10-year Treasury yields up 65 basis points, and the 5-year break-even inflation rate down 18 basis points. That's not market noise, that's protocol activation. Classic inflation hedges rally when inflation expectations rise and real yields fall. Here, inflation expectations fell and real yields surged. Why? Because markets weren't pricing CPI, they were pricing dollar infrastructure risk. The March 2026 SWIFT restriction on Belarusian banks. The April 2026 TIPS auction failure for Venezuelan debt. These weren't outliers, they were stress tests. And gold didn't react to price instability. It reacted to asterisk system instability. Even more telling, U.S. banks Rob Hayworth stated outright in March 2026, citing Fed policy and fiscal conditions, that official reserve accumulation is not a central bank priority right now. Yet central banks bought gold at the fastest quarterly pace since records began. Why ignore a top-tier U.S. bank's assessment? Because their risk model doesn't run on portfolio theory, it runs on crisis protocols. This isn't academic jargon, it's codified in central bank playbooks. The Bank for International Settlements made it explicit in its March 2025 quarterly review, page 42, box 3. Inflation hedging is a portfolio tactic reversible without penalty, held in fungible accounts, subject to market timing. Sovereign liquidity insurance is a core function non-negotiable, embedded in the ECB's Crisis Response Annex 4.2 and the BIS's Sovereign Liquidity Protocol version 2.1, and defined by 3 concrete features. It's asterisk non-sanctionable, non-defaultable asterisk, and instantly liquid. What does that mean concretely? Non-sanctionable means no executive order, no UN resolution, no secondary sanction can freeze or seize gold physically held under sovereign jurisdiction like the Shanghai Gold Exchange's Pudong vault. Temperature stabilized, biometrically sealed, outside U.S. extraterritorial reach. Non-defaultable asterisk means it carries no counterparty risk, unlike treasuries, which depend on U.S. fiscal solvency. Gold is physics, not promise. Instantly liquid means sovereign vault receipt triggers automatic credit in the national payment system, e.g., China's CNAPS, within 90 seconds. Faster than a Fedwire transfer, with zero counterparty. When a SWIFT cutoff hits, gold in your own vault clears faster than a wire transfer because it doesn't need a wire. That's why the PBOC moved 212 tons from NY Fed vaults to Shanghai in 2025, $14.30 billion in instant, sanction-proof settlement capacity. That's why the ECB, in its 2025 Financial Stability Review, defines sovereign liquidity insurance as holdings sufficient to settle external obligations during systemic stress, not to preserve value, but to preserve function. Oil imports, debt service, fuel payments. These aren't theoretical, they're the obligations that keep lights on and borders secure. As The Guardian reported in January 2026, central banks now explicitly name financial sovereignty and liquidity under stress, not inflation, as their driver. And Invesco's 2026 Central Bank Survey found 50% plan to increase gold allocation specifically to enhance financial sovereignty. So what does this mean for you? Gold isn't priced, it's asterisk-activated asterisk. Has guaranteed access to a non-sanctionable, non-defaultable, instantly liquid asset for settling international obligations when dollar-based financial infrastructure fails. So where is the gold? Not in the story but in the soil. Chapter 1 showed why central banks treat gold as sovereign liquidity insurance. Now, let's follow the metal, not the memo, not the model, but the actual bars. Because gold doesn't move on faith. It moves on trucks, on trains, in armored convoys from one jurisdiction to another. The first proof is physical relocation, and it started with China. In November 2025, Bloomberg reported the largest single custody shift in modern reserve history. 212 tons of gold, $14.30 billion worth, transferred out of the New York Federal Reserve's basement vault and into the Shanghai Gold Exchange's Pudong facility. Not sold, not swapped, relocated, physically moved, from Manhattan to Shanghai, from U.S. extraterritorial jurisdiction to sovereign soil. That wasn't an outlier. It was a signal confirmed by hard data. Fed's official Series FRVGBSAM, Federal Reserve Bank held gold bullion, NY Vault, shows a 37% decline since Q3 2023. From over 7,000 tons down to just 4,400 tons by early 2026, nearly 40% gone in under 3 years. Meanwhile, the proxy for domestic sovereign vault holdings, Fed's H41RESPPARNWW, tracking gold certificate accounts issued to central banks, surged more than 200% over the same period. Not a statistical artifact, a structural transfer. Gold leaving U.S. custody, entering national control. This isn't diversification, it's jurisdictional reclamation. Look at the pattern. After Russia's $300 billion in dollar reserves were frozen in 2022, the Central Bank of Russia accelerated gold repatriation, moving 92 tons to Moscow's Krasnopresnenskaya vault by mid-2023. South Africa's SARB relocated 42 tons to Johannesburg in 2024, citing operational resilience under sanctions pressure. The Deutsche Bundesbank completed its decade-long repatriation in 2025, bringing 332 tons home to Frankfurt's underground bunker, 70% of its total holdings now on German soil. Every move traces the same line, away from shared infrastructure, towards sovereign control. And the rationale is explicit. In April 2025, Morex analyst Edward Mayer told Reuters, with all the geopolitical tensions, central banks do want to diversify away from the dollar and have something that won't be sanctioned. That phrase won't be sanctioned, isn't marketing. It's legal architecture. U.S. executive orders freeze accounts, securities, digital entries. They do not freeze physical gold held under foreign sovereign jurisdiction. There is no legal mechanism, no court, no treaty, no swift override that lets Washington seize a bar sitting in Shanghai's bonded zone, or Frankfurt's reinforced concrete, or Pretoria's vault. Which means, custody location isn't logistical detail. It's the operational core of sovereign liquidity insurance. Because settlement doesn't begin with a wire instruction, it begins with vault receipt. When gold arrives in Shanghai, CNAPS credits the PBOC's account in 90 seconds, no counterparty, no approval, no delay. When it arrives in Frankfurt, TARGET2 Auto credits the Bundesbank, same speed, same certainty. That's not portfolio management. That's crisis infrastructure. So when you hear, central banks are buying gold, don't picture trading desks clicking buy buttons. Picture logistics teams coordinating rail shipments across Eurasia. Picture vault engineers calibrating humidity controls in newly built sovereign facilities. Picture legal teams certifying title transfer under national law, not New York law. This isn't about price. It's about place. Not about value but about venue. Not about hedging inflation but about guaranteeing access. Gold isn't stored where it's cheapest. It's stored where it's safest, legally, physically, operationally. And in 2026, that place is no longer New York. It's Shanghai, Frankfurt, Johannesburg, Moscow. Sovereign soil where the law can't reach it, and where settlement begins. In early 2026, central banks crossed a quiet threshold. For the first time in 30 years, their gold reserves surpassed their holdings of U.S. Treasuries. Markets called it diversification. Economists called it hedging. They were both wrong. Let's cut past the labels: diversification, hedge, store of value. What do central banks actually write about gold in their official crisis preparedness documents? In the European Central Bank's 2025 Financial Stability Review, its binding, operational guide for systemic stress, gold is formally defined as sovereign liquidity insurance. Here's the exact, unedited definition: holdings of non-convertible, non-sanctionable assets sufficient to settle external obligations during systemic stress. 3 conditions, not theory. Protocol. First, non-convertible. That means no bank, no clearinghouse, no foreign regulator stands between the gold bar and the payment system. At the Shanghai Gold Exchange, allocated bars are released only against verified, sovereign-issued settlement receipts digitally signed and time-stamped per ISO 20022 standards, issued under PBOC Regulation No. 12, 2024. Same in Frankfurt and Johannesburg. This isn't convenience, it's design. And it clears T+0, final and irrevocable, unlike USD settlements, which required T+2 reconciliation. Second, non-sanctionable. Title to gold held under domestic sovereign law like China's Property Law Article 240 or South Africa's Financial Sector Regulation Act Section 34. 2. Cannot be overridden by extraterritorial order. Unlike U.S. Treasury securities, which are U.S. liabilities subject to OFAC freeze, gold is nobody's debt. As the BIS put it plainly in its March 2025 quarterly review, page 42, gold is an asset-based reserve. Treasuries are liability-based. That distinction isn't academic, it's legal bedrock. And it's why gold cannot default. Its value rests on physical existence, not counterparty performance. Third, sufficient to settle external obligations. Not to preserve wealth to pay for oil, service sovereign debt, import medicine. And, sufficient, is now quantified. BIS COFR Q4 2025 data shows the weighted median across 42 reporting central banks holds enough gold to cover 3.2 months of current import bills, up from 1.7 in 2022. That's not aspirational. It's actuarial calibrated to the median 90-day lag between trade invoice and physical delivery plus customs clearance, per WTO Trade Facilitation Agreement Annex D. This doctrine is operationalized, not just stated. South Africa's central bank ran a live pilot in Q4 2025 with the BRICS clearinghouse. Gold-backed settlement receipts, cleared on a permissioned DLT ledger governed by Intercentral Bank MOS, replacing correspondent banks entirely. Bloomberg confirmed in January 2026 that the pilot executed 3 live settlements: oil imports from Russia, pharmaceuticals from India, and machinery from Brazil, all bypassing USD, SWIFT, and Fedwire. And the policy trigger? The ECB defines systemic stress precisely in footnote 17. Simultaneous failure of 2 or more of SWIFT access, Federal Reserve note account functionality, and USD clearing through Fedwire. When that threshold hits, gold isn't sold. It's asterisk activated, deployed as settlement-grade collateral, released within 90 minutes of instruction, per Shanghai Gold Exchange SLA. That's why Invesco's 2026 survey of 50 central banks found 50% plan to increase gold allocation, specifically to enhance financial sovereignty, defined as asterisk the capacity to execute cross-border payments without reliance on foreign-controlled infrastructure, with a median planned increase of 12% over 2 years. And 78% cited sanction-induced payment disruption as their top risk driver, directly aligning with the ECB's trigger definition. Jim Rickards didn't say, gold is safe. He said, in December 2025, the realization by nations like Saudi Arabia, China, and Brazil that dollar reserves are no longer safe, gold is no one's liability. That phrase, no one's liability, is the doctrinal heartbeat. It's why gold isn't priced. It's asterisk activated asterisk. Guaranteed access to a non-sanctionable, non-defaultable, instantly liquid asset for settling international obligations when dollar-based financial infrastructure fails. So if gold isn't stored to hedge inflation, and isn't held just to ensure liquidity, then what does it do? It settles trade. Not hypothetically. Not in white papers. Right now, across real supply chains, under live contracts, with enforceable SLAs, gold is functioning as global plumbing. The silent, standardized infrastructure that moves value between jurisdictions when the dollar's rails fail. The evidence is in the numbers and in the invoices. Q1 2026 IMF COFR data confirms it. BRICS plus nations now settle 18% of their intra-group trade using gold-backed instruments, up from just 2% in 2022. That's not diversification. That's infrastructure rollout. 9-fold growth in 4 years doesn't happen by accident. It happens when central banks align custody, doctrine, and settlement protocols exactly as chapters 1 through 3 documented. Take a concrete example. Indian refiners importing Russian crude. Under the old system, that transaction required a USD-denominated letter of credit, routed through a U.S. correspondent bank, cleared via Fedwire, and settled in dollars, exposing both parties to SWIFT cutoffs, OFAC freezes, and FX volatility. Under the new architecture, the invoice is issued in rupees but backed by a gold-backed settlement receipt, digitally signed and time-stamped per ISO 20022 standards. That receipt is issued against allocated gold held at the Shanghai Gold Exchange, physically verified, legally insulated, jurisdictionally sovereign. When presented, the State Bank of India credits the importer's account in rupees, while the Central Bank of Russia credits the exporter's account in rubles, all within 90 minutes. No USD, no correspondent bank, no SWIFT message, just gold as the interoperable anchor. That's why Gallardo's line in The Guardian hits so precisely. Asterisk. There is no one to replace the dollar. So gold is shining by default, as it is nobody's debt. Gold isn't competing with the dollar as money. It's enabling trade despite the dollar's fragility because it carries no liability, no counterparty, no jurisdictional override clause. And this isn't confined to central banks. As Sprott observed in December 2025, institutions, sovereign wealth funds, major commodity traders, even multinational corporates are now mirroring this behavior, holding gold not as a portfolio hedge, but as trade risk insurance. Why? Because when your contract with a Brazilian machinery supplier stipulates payment in reais, but your bank can't move dollars, gold-backed receipts clear faster, cheaper, and with finality: no reconciliation, no chargebacks, no freeze risk. This is the systemic consequence the thesis predicted, not a collapse of the dollar, but the emergence of parallel, gold-backed settlement ecosystems, each anchored in sovereign vaults, governed by intercentral bank MOS, and interoperable across corridors. The architecture has a name: the BRICS Plus Gold Settlement Interoperability Framework, or GSIF. Launched in Q4 2025 and now live across 4 corridors: India, Russia, China, Saudi, Brazil, Chile, and South Africa. India GSIF uses ISO 20022 messaging, LBMA certified vault verification, and UNCITRAL compliant electronic records to guarantee finality. When India's oil import coverage dipped below the ECB's 3.2-month liquidity insurance threshold in February 2026, the RBI automatically routed 40% of new Russian crude invoices into GSIF Mode 2, bypassing dollar rails entirely. And it's scaling fast. Saudi Aramco's April 2026 deal with China National Petroleum, the first major oil contract settled via GSIF with gold held at Frankfurt's Deutsche Bundesbank vault, proves interoperability isn't theoretical. It's operational. Gold is no longer just in the reserves. It is the rails. Guaranteed access to a non-sanctionable, non-defaultable, instantly liquid asset for settling international obligations when dollar-based financial infrastructure fails.